Okay, folks, welcome to Sunday Night Futures Live. I hope everybody had an awesome weekend. I'm looking forward to the new trading week, and thanks for being here. Like, subscribe, you know the deal. We had the futures that are open, and really what we want to talk about is where to from here. If you listen to Jay Powell's Jackson Hole commentary on Friday, my knee-jerk reaction was that he was running a victory lap, claiming victory over inflation. There's only one problem: inflation is not down to 2%. And so I often say that the knee-jerk reaction to any event, news item, and whatnot is usually the wrong reaction. So I kept thinking about whether or not my interpretation of his very, very confident, very, very dovish speech, meaning interest rate cut sensitive, was it confidence or was it a con? Was it panic? Is he worried about something that could be out there that we don't know what it is yet? Could it be the Japanese yen uh, risk trade, meaning the carry trade that impacted the markets the first week of August? Maybe. Is it commercial real estate? Maybe. We're going to touch on these topics tonight. We're going to go over the charts. And we're going to go over the news items that hit the headlines over the weekend, including geopolitical risk, more risk out of the Middle East with Israel striking targets in Lebanon, Hamas targets, and they're friendly with the Iranians. So we'll see whether or not there's going to be any type of counter attack, whatever. So let's get to it. Let's share my screen. Let's say hello to folks. Good evening to you, Franklin. Thank you, sir. Appreciate that. Audio's good. Tim Ferga, great to be back. Great to have you back. Mr. Sean, welcome. Thank you, sir. Okay, so we're going to go over the futures action. And let me get my mug down to a thumbnail. And there we go. Okay, so we're kicking off the new trading week with a tick up higher in the NASDAQ 100. They lagged last week with the mid caps and small caps outperforming the S&P 500 overall. Let's see whether or not there's carry through. Now, the mid caps and small caps were up pretty big on Friday. Would not be out of the realm of possibility that we get some sort of a rest early on this week. So we're kicking off the week fractionally higher here on the NASDAQ. Let's put some alerts up here to see whether or not we're going to take out the afternoon's highs on Friday, which I think we're going to. Now, moving on to the ES, the E-minis, S&P 500. These are 5-minute charts. S&P 500 up about the same as the NQ. Let's set up an alert here. Now, looking at the Russell 2000, big move up higher here, up nearly a third of a percentage point at the open. So the money continues to rotate into the small cap names that had a very strong close. You take a look at this chart and you get your typical textbook stair step price action, right? Stair step 1, breakout. Stair step 2, breakout. Stair step 3, breakout. Textbook stuff. Very solid beginning of the new trading week here on the Russell. The Bollinger Band squeeze is on. You can see how tight the Bollinger Bands are. This is only a 15-minute view, but look at how tight they are. And I talk about this all the time. These Bollinger Band squeezes, once they fire off, in whatever direction they choose to fire off, the move is explosive. Taking a look at the Dow. Dow up fractionally, consistent with the NASDAQ 100 and the NQ. Let's find the mid caps. Let's see what they're doing right now. That's not the mid caps. All right, we just made new higher highs relative to Friday on the NQ and on the E-minis. Mid caps are up, consistent with the Russell 2000, up about 1/3 of a percentage point. So it's clear where the money is rotating into in the equities market, mid caps, small caps, with the larger cap names being laggards. And we spoke about this on over the weekend. I did 2 videos over the weekend. Yesterday was when we did the scans for the stocks that we were looking for to put on our best stock list for the new trading week. And I showed the ratio charts of the small caps relative to and the mid caps relative to the S&P 500. It's clear, it's defined, large cap, mid caps, sector rotation going on here, undeniable. So looking at the US dollar at the open here, the dollar has been under a lot of pressure. It's probably going to come under more pressure. We're going to talk about this a bit more in a moment. So we're opening down about 0.05%. The dollar doesn't usually move much on a Sunday night. You see more action usually in euro yen. And the yen is just lifting off here. Up 0.14%. That's a pretty heavy move for the yen, to the upside anyway. And looking at the euro is up fractionally. It's off of its highs. So the yen is leading the euro. Now looking at the Aussie US dollar, Aussie dollar, I keep doing that, yen, what am I doing wrong? Here we go. So there's been a very, very tight correlation between the equities market here, the large cap equity names, and the Aussie dollar, Japanese yen. Going to ask me why? I don't know why. Okay. It just is. So you can see that we are weakening up here with the strengthening yen. The question is, does it impact the equity market? Does it impact the large caps? We don't know. They're about 75% correlated at last look. Let's see whether or not the NASDAQ is responding. As a matter of fact, let's go to the E-minis rather than the NASDAQ. No, it's shrugging it off at current. Looking at commodity prices, oil moving up, probably on the heels of the news out of the Middle East. No shock here. Oil had a good comeback at the back half of the week last week. It was down. It had a savage beating most of the week. Then Thursday, Friday, big rallies back. It still closed down in the week, but well off the lows of the week. So oil catching a bid here in the Sunday futures session. Let's take a look at nat gas. Nat gas gapping down. We saw this a couple of weeks ago where we had a gap down on natty gas, and then it did a reversal up higher and engulfed. This candlestick. This is the micro. Guys, we're going to throw we're going to throw an order out here. We just bought some nat gas. Let's see whether or not we get a move up higher. Okay. Small position. And if we get an engulfing, if we engulf and we close above this resistance level here, I would add more to the trade, but not until then. Now we did currencies. Let's go to agriculture. This is what? This is this week's price action. No, that's last week's price action. Yeah, last week's price action. Lots of topping action here. It looks as though on corn, we're going to need a washout on corn. I would not be a buyer here. You need one last push down. Soybeans. Soybeans closed well last week. An inside bar, in fact. How are they opening up here? Not too bad. Pretty good. Let's see if they take out last week's high. All right, let's see what else we got going on here. We did corn, we did soybean, wheat. Wheat did not have a good week last week. It broke support. Very, very poor price action on wheat. I'm not a buyer here at all. What else do we have to go over? I think we did it all. That was quick. Let's check back with the S&P 500 and the Aussie dollar pairs trade. So the Aussie dollar continues to weaken up relative to the Japanese yen. Okay. All right, this is our first 15-minute bar of the week. Let's see how we closed out on the NQ. Looks like they're going to take it up higher. One last check with natural gas, down about a half percentage point. Okay. Let's go to comments, see where I left off. Polish taco. Love the name. How can I say no? Of course. Sure. That's too funny. That's a great name. That soundbite familiar? Is this Thinkorswim? What the background noise? That noise it makes? Yes, Thinkorswim. Paul, welcome. Mr. Pete, welcome. All right. Let's get to it. Let's talk about what's going on this coming week. Let's talk about the concerns. Let's talk about the good stuff out there, right? There's got to be good stuff going on. So let's talk about it too. Fair and balanced. All right. We didn't go over this on Thursday night, but this is the Federal Reserve's balance sheet. And their balance sheet took a nosedive last week. It had flattened out for a while. July was pretty much balanced. Most of August balanced. Not much change there. It even lifted up higher the week of the 7th. Then last week, it took a $39 billion drop. So the Federal Reserve, this really begins our conversation about Jay Powell and what he was trying to communicate on Friday. Was he doing a victory lap? Was he doing legacy stuff, trying to set the stage for his departure at some point down the road, claiming victory? Maybe. But the more I think about it, the more I think that he's probably concerned. And when you look at how much debt they rolled off their balance sheet, this is providing liquidity to the marketplace. Excuse me, my apologies. This is taking liquidity out of the marketplace. So they continue to roll off debt off their balance sheet. He's showing some confidence here, but I'll tell you that the uber dovishness on Friday was really out of character for him, and it's suspect. But right now the markets don't care. I had thought that maybe over the weekend the markets would kind of be like, you know what, maybe he was a little bit too confident. Why is he so confident? I don't know. And maybe they would get a little bit more skeptical. Right now at the open, it doesn't appear so. Let's talk about economic data coming out this week. We get durable goods coming out on Monday. Big number. Very, very important. Consumer confidence, that's a 10 a.m. number. Be careful of that one, you day traders out there. Wednesday, Fed head, not a big deal. Thursday, initial jobless claims. That, for some reason, has become a popular report. We get a revision for GDP. I don't think that's all that. Well, you know what? Watch for the revision nowadays. We've learned our lesson with this administration. Watch for the revisions. More Fed heads out. Wednesday, we get PCE. This is inflation data. This is the Federal Reserve's favorite measure of inflation. So keep an eye on it. Earnings coming out. It's slow early on, but then on Wednesday, that all changes. We get NVIDIA, we get CrowdStrike, we get Salesforce.com. Salesforce.com disappointed last quarter. CrowdStrike, this is going to be an interesting one. I wouldn't touch the stock with a 10-foot pole given the events that happened a couple of weeks ago. I think you got to wait a bare minimum of another quarter to find out exactly how that's going to impact their business. We'll learn about that more on Wednesday night. And if they don't talk about it, look out below for the stock. NVIDIA, I see that Franklin has a comment in here. Bob, your thoughts on NVIDIA set to report its earnings on August the 28th after the market closes. Listen, it's had a heck of a rally off the lows of the month. By and large, the AI story, they are the poster child for it. And if they disappoint, and there's any number of ways they can disappoint because the expectations for them are so high that it's very easy to miss, very easy to disappoint. But if you get a real serious disappointment, meaning margin contraction, orders come in, they're feeling their revenues miss, and revenues are really key. EPS can be talked away, but revenues, that's sales, and that's a problem for the company moving forward, especially one that on a rearview mirror basis is pretty expensive, on a forward-looking basis, not so expensive. So I think that they are, I'll put it to you this way. As goes NVIDIA, so goes the triple Qs. If NVIDIA can't hold its mud, in all probability, the rest of the Qs are going to take a backseat, as they have been, to the Russell 2000 and the mid caps, and quite possibly the Dow Jones Industrial Average. So, and I'm not saying that they're going to crash. I'm just going to say that they're laggards, because we need to put into context what is coming down the pike. What is coming down the pike, it's guaranteed, foregone conclusion, yields are going lower. So historically, going back to 1950, what sectors of the economy outperform when you get rate cuts? That are your industrials, utilities. Why utilities? Because yields go down. That reduces the cost of borrowing for utilities when they put debt out into the bond market, and they're able to pay bigger dividends. And plus, If they start chopping yields down on treasuries down to nothing again, well, those utility stocks and their dividends are going to look pretty good. So other names that are out there that do well are like 50-50 financials over the course of history, and 6 months out from the first rate cut, generally the small caps, mid caps outperform the large caps. Why? Their cost of borrowing goes down. The stimulus in the economy allows for them to sell more stuff. So as their businesses improve, and hopefully they improve, because here's the problem for the Federal Reserve. If their rate cuts are insufficient and you do not stimulate the economy quickly, then what's the need for the small cap companies to go out and buy more stuff to try to sell stuff to a customer that's not there yet? So the Federal Reserve, I think, is in a tough spot. I think they're in a tough spot. In reality, they have yet to defeat inflation. Yet the jobs picture is picking up. We've been talking about this for a while. It's picking up to, you're seeing the yield curve, not the yield curve, the U6 and the U3 BLS unemployment numbers rise now. That's over 3 months in a row. We're seeing those numbers deteriorate. So that is not good for the Federal Reserve. That goes against their mandate: fight inflation and the secure employment. So if inflation comes back in earnest, well, what's the Federal Reserve to do? They're going to have to cut really, really rapidly. But the problem is they only stoke the flames of inflation. I mean, it's a really bad spot to be in. I don't know what they did, to be honest with you. Now, looking at the CME FedWatch tool, yeah, I'm going to talk about that. I have that up here in a moment to talk about, TZ. We're definitely going to talk about it. Tim, yes, ORGN. Okay. So we're definitely going to talk about that. That's very important. So looking at the CME FedWatch tool, a lot's changed here from, not a lot. It's changed here a bit. The probability of only a quarter basis point cut in September is now 63.5%. You know, I keep going back to this. We had a revision downward on jobs data by over 800,000 jobs that were just simply made up and calculated into the Federal Reserve's projection of where interest rates should be. This has gone over the course of the past year. So 6 months out of the past year, we were in rate hike mode. Rate hike mode. Did they cut too much? And should they be cutting more? Is the question I have for the Federal Reserve right now. Apparently, the market participants do not believe that we should be expecting anything more than a quarter basis point cut. Is that sufficient to stem the damage to the jobs market that has actually been sustained, not what was falsely reported by the Bureau of Labor and Statistics? Now, this goes to TZ Burton's comment. You know, we've entered a time, and it all began in earnest with COVID, where we've gone down this road of censorship, of mandates, of totalitarian behaviors on the part of the Western countries that we would only imagine being seen in the Soviet Union, China, and some tin pot dictatorships around the globe. Never would you have thought that it would occur in Western so-called civilized societies. You've had Brits that have been thrown into prison now for posting or reposting tweets or posting on Facebook. And I'm not talking about for a couple of days. I'm not talking about serving community service. I'm talking about going to jail for years for simply retweeting or making a comment on social media. So you take a look at the report that came out over the weekend that billionaire Telegram CEO Pavel Durov arrested in France. Now, for those not familiar with Telegram, I use it from time to time. Rarely do I use it, but I do communicate with my developers over in the Ukraine with Telegram. They use it because it's secure. Now, the problem is the intelligence communities supposedly are unable to read the messages inside Telegram, and they hate that. The governments want that access. So what do? He's originally from Russia, but he's got dual citizenship in Dubai and in France. So Pavel Durov, the billionaire co-founder and CEO of messaging app Telegram, was arrested at the Bourget airport outside of Paris Saturday evening, according to blah, blah, blah name source. So they're probably going to try to squeeze him to give up whatever source code is necessary to get in there and read those messages. So the message is made loud and clear right now to TikTok. Cross that one off. They're completely controlled now. Telegram, check that box. They're probably coming under pressure. Rumble, we know, has been under pressure, but they fought it off. X is coming under pressure. And here's another headline that just came out right before we went live. Musk should be nervous. Deep state lackey admits real target following Telegram's founder's arrest. So they're coming for these guys. And I don't think that it's any coincidence that it's happening in advance of the U.S. elections here. Interesting. One little known feature of the war is that the Ukrainian military largely communicates via Signal and the Russian military via Telegram. Interesting. More geopolitical events occurring over the weekend. Israel launched preemptive strike on Hezbollah in Lebanon to prevent major attack. So will there be a reaction by the Iranians? Who knows? But it's out there, and it's certainly sending oil prices up at current. Now let's talk about the incompetent bureaucrats, the totalitarians that want to be in control of our economy and currently are in control, and you can see what a mess we are in. Dems scramble to walk back Harris's price control scheme. We spoke about this last Sunday. And I want to play for you the half end of this interview with Pocahontas, Elizabeth Warren, and Joe Kernan, because it speaks volumes to the just the lies that we are being fed. So I'll give this a listen. Let me make sure that I am sharing audio with you folks here. I'm going to stop screen sharing, make sure that I am sharing. Audio is on. Yes, good. We're good to go. Let's hear what Liz Bett has to say.
Look at what happened to their profit margins. If they'd just been passing along costs, profit margins would have stayed about the same. But for some industries, some companies, profit margins shot up. And do you know where they shot up most often? It was in companies or in industries where there was a lot of concentration, a lot of market power. Places where the market is not functioning competitively. So you end up with someone, you remember we all talked about egg prices. You end up with something like this giant egg producer, Cal-Maine. And Cal-Maine raises the price of eggs. Their profit margins increase by 718%. That's not just passing along costs.
I'm going to pause here for a moment because what Joe Kernan does is attempt to call her out because she's cherry picking figures here to make herself sound good and rational, which she is entirely not. Anybody that knows her, she's insane.
Senator,
and that is a time in
that's
any
sophistry. Your example on Kraft. Your example on Kraft is even worse.
You finished first. In any of the states around the country that already have price gouging laws in place.
Can I tell you why those are fallacious and misleading at best? And your Kraft analogy is even. Why can't I tell you? Please let me tell you. Kraft, you say, was 440% profit increase. The example you used, the prior quarter from the year before, they had a charge of $1.3 billion, an accounting change which wiped out profits. Then they earned what they normally. Let me finish now. They earned.
You didn't let me finish. Look at the data. Come on. We have economic study now after economic study.
This is the way it always goes.
When there is more concentration,
40 million eggs were destroyed because of avian flu.
When there is more concentration in an industry, we have seen much greater increases in
Do you attribute the inflation?
Margins.
That's what you think we need to do to solve it?
They're not random. They are not random one-offs. It is part of the problem when you've got companies that are gouging consumers on prices. Consumers need to know they've got somebody on their side.
Senator,
and
listen, we're trying to help. We're trying to actually do.
Where are you in the 37 states that currently have price gouging laws?
Just quickly on that point, Senator.
Okay, so she's cherry picking numbers. Cal-Maine Foods, a company that I used to own at that time, had to destroy a tremendous amount of their product because of the avian flu. So they took a charge, they took a hit. So once their sales bounced back, what she's doing is saying they're price gouging, their earnings were up 700%. Yeah, because they got destroyed on the prior quarter. But she doesn't want to. It's not the narrative they want you to hear. They want you to hear that they're on your side. Price controls are good, but nobody can go back into history and point out a single time that price controls have ever worked. And the great Milton Friedman says it better than none other.
You know, economists don't know much, but there's one thing we know very, very well, and that's how to produce shortages. Tell us what you want a shortage in. If you want a shortage in lettuce, we'll set a maximum legal price for lettuce below the price that prevails in the market, and I guarantee you'll have a shortage of lettuce. You want a shortage of housing? In New York City, we'll set a maximum price, rent control, a maximum price on rent. You'll have a shortage of housing. You want a shortage of funds available to borrow for mortgages? Just have a usury law that sets a maximum limit on the interest rate that may be charged. And if that usury law sets a limit below what would otherwise prevail in the market, you'll have a shortage of funds available for mortgages. In the same way, if you want to have the appearance of a shortage in oil, just set a maximum price on oil. Make it unprofitable for people to produce it. Make it profitable for people to use it. And what we have been doing in oil, as a result of that oil price control imposed on August 15th, 1971, we have gone the standard natural route of government controls.
One thing I love about Milton Friedman, he takes complex topics and he's able to tell a story and make them very easy to digest. Very wise man. So she wants price controls as a way for the government to help the American consumer. God help this country if she gets in. All right, let's talk about the markets. Let's talk about where we're at. It's a tale of two competing. How do I put this? Competing forces. We have on one side, we have what is perceived to be very bullish news coming down the pike. And there's always the old saying out there, don't fight the Fed. And it's true. It's true. Going out in history back to 1950, even if you have a steepening of the yield curve, 6 months after the first rate cut, normally the markets are up. Nobody here is arguing that. Nobody. The question is, what happens between the first rate cut and equilibrium? What is equilibrium? Well, we need to understand the true reason of why the Federal Reserve is cutting rates. Is it for joblessness? I heard a statistic that in New York, the applications for unemployment haven't moved. So is it really joblessness, or is it something else out there? Is it liquidity? Because the liquidity strains on the market right now are at levels that we haven't seen in quite some time, and usually right before an event. And have no doubt that Japanese yen carry trade is and was a liquidity event. The question is it over? We don't know. Is it something else? Is it commercial real estate? My father called me right before I went live. I was preparing for the show, and his background is he had multiple businesses. He was in real estate, and so he's always watching the news in real estate. And he says, I got that vibe. And usually he's pretty bullish about the market, about the economy. And I got that vibe again that something's not right. Circa 2007, right before the financial crisis. I said, what are you talking about? And he goes, he shared with me an article I'm going to share with you in a moment. So right now, on the bullish camp, we want to be fair and balanced. What do we expect for the stock market to do tomorrow without any geopolitical risk-off news? It's going to go up. How do we know that? This is shared by J.C. Peretz. The New York Stock Exchange advanced decline line, new all-time highs. That's very, very bullish stuff. That's broad-based participation. Very bullish stuff. Nice round cup, shot up out of a base, and it hasn't looked back. Nice stair step up higher. Good stuff. Other reasons why we should be bullish. From Ryan Detrick. Friday saw nearly 11x amount of advancing volume to declining volume on NYSE. This is the most since October 17, 2022, the lows of the bear market. I found 47 other times when it was 10x since 1979. Higher a year later, 85% of the time, and up nearly 13% on average. This is not bearish. I agree. Yes, I agree. But one thing I want to point out right here is that in October of 2022, that's when we went into the seasonally very strong half of the year. November is by far the most bullish month out of the year for the S&P 500. Second comes December, usually with July on parity. But then we went into a bear market in 2023. Actually, no, I'm sorry, 2022. I stand corrected here. I misread this. I'm wrong. It's bullish. I made a bad point. I attempted to make a bad point. I thought that 2023 was the bear market. I got it wrong. All right, so bullish stuff. Advances versus decliners and the advancing volume. Very, very good. The other side of the coin is this, is why do we have an inversion of the yield curve happening? And why is it now steepening? This is generally not a bullish event when you get steepening in the yield curve. We moved up last week 33.7% on the yield curve, or 6 basis points, a pretty healthy move. So what we're going to be looking for this coming week is this, because this is the final week of the month. Do we break out? Do we close above the highs of July? Because when you take a look at a monthly chart here, you could see RSI momentum is just unbelievably beautiful. Stochastics, uptrend, rising, beautiful. Price action, similar to last month. I don't like the topping action. I think that's somewhat bearish, but net, we have new monthly higher highs. If we close at the highs of the month this week, that puts us within 1 basis point of uninversion of the yield curve. So what the bond market is telling us is there's something very, very wrong out there, and that you had better buckle up, because generally this does not end well. I'm not debating that 6 months from now, the stock market can't be higher. But in the short run, it doesn't mean good things until we get equilibrium. A quarter basis point rate cut is going to do nothing from September, because it's going to take 6 months for it to work through the economy. So what's going to happen is things are going to have to get ugly. And it's going to have to force the Fed's hand to have emergency rate cuts on a Sunday evening, and half basis point rate cuts. I think they did a 3/4 basis point rate cut back during the COVID sell-off. So it's that type of action by the Federal Reserve that's going to be necessary to put a bottom in under the market. But this assumes that there isn't an event out there that we should be concerned about. Yen carry trade, liquidity, or is it something else? U.S. households are struggling. U.S. household income expectations over the next year dropped to the lowest in 4 years. Consumers now anticipate a mere 0.8% year-over-year income increase, a sharp decline from 2.5% rise expected in Q1. Over the last 50 years, such a rapid drop in expectations has only been seen during the 2008 financial crisis and the 2020 pandemic. At the same time, Americans' perception of real income improvement is at its lowest in over 10 years, even below 2020. These expectations do not bode well for consumer spending. Doesn't give you the warm and fuzzies. The Kobesi letter. This is truly concerning. The number of states with rising month-over-month unemployment reached its highest level since 2009. The 12-month moving average of states with higher unemployment recently reached 20 and has doubled in just a few. So we spoke about this earlier, that we're seeing unemployment, non-farm payrolls, they have been rising over the past several months, and now they have adjusted over the past year that we have actually 818,000 jobs less than what we thought we did over the past year. That came out last week. To the dollar, we've been talking a lot about currencies receding. The dollar, every single stock market crash beginning in 1987, 98, 99, 2000, blah, 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 were all preceded by a U.S. dollar sell-off, specifically against the Japanese yen, as foreign investors begin to deleverage from the carry trade. We've spoken about this for several weeks now. And what did the dollar do? So far this month, it's down over 3%. This is a pretty massive move for the dollar in a single month. And what we're doing is now, I need to really update this chart, because the last time I updated it, we were looking at a breakout here on the dollar. Now we're looking at a breakdown. Let's go to comments. Michael Anthony, welcome. CLW, is that Clorox or that's CLX? Isn't markets at all? No, we're just off of highs. Just off of highs. So you buy companies like GTM, which already paid for the rest of the debt. If you're talking fundamentals, I defer to Investors Business Daily. I outsource my fundamental analysis. We need Trump more than we need Trump. Agreed. Jesus, Michael, you're on fire here tonight. Let me check that out. You got me second guessing myself here. No, 2023 was more of a we were coming out of a bear market. 2022 was more of a bear market. All right. Bob, that was a good point about the egg increase over the last 3 years. Hundreds of food processing plants. Correct. No coincidence, just probability. Exactly right. Exactly right. The futures are reversed. I didn't put any alerts out there. Thank you for that, Tim. Let's check it out. I know that Aussie dollar trade was not going the way it should for the equity markets. And Tim is exactly on point here. We've seen a reversal in the E-minis. They were up at the highs, I believe, 0.10%, now down 0.13%. Let's go through these really quick. NQ now down 0.22%. Surprising here. We were up about a third of a percentage point on the Russell 2000. Now we're up only 0.09%. We need to look at the Aussie dollar trade right now. The Aussie dollar is down nearly a half percentage point relative to the Japanese yen. Let's check in with NAC. I put on a trade in NAC gas earlier. That didn't work out well. We're coming off our lows. Okay. Let's go back to it. Thanks for that, Tim. Appreciate it. Oh, you know what, folks? I didn't mention, for those that are on, we're launching on the 30th, our Contrarian Trader Public Forum. It's free, no credit card. But what we want to do is we want to build up our audience, and we want more engagement, more networking, sharing of ideas, and providing constructive feedback to members on their trade thoughts. And also, this will be the last public Sunday Night Futures Live for the foreseeable future, because the next time we do Sunday Night Futures Live is going to be live inside the forum. And that's where we're going to be able to post stock chart request, small account club, premium content replay, trade data feedback. Post your trades. Let's talk about them. We'll be able to have feedback. It's like a Facebook type format, not some cheap Discord channel. So enter your email address if you're watching this on Twitter, link above, YouTube, link below, or use this QR code and you can scan it right from your screen and join. We're launching on Labor Day weekend, so join us there. I'll see you on the other side. No credit card required. All we want is constructive engagement. That's it. And it'll be free for a limited period of time. Once the community has roots, it's thriving, then at some point in time, I'll charge a small fee just to pay the bills and keep the lights on. That's about it. But right now, it's free. Take advantage of it. And the only time you're going to have to pay is if you cancel, all right, and you come back, all right, and take advantage of it. All right, enough of that. So my father had given me a call, as I mentioned earlier, about getting a vibe. And my father's, he's up there. He's seen a lot of stuff. And if I said his age right now, he'd jump through the screen at me. So I can't say it. He's a young lad. So Wells Fargo had sold their their subprime business to Citi Mortgage back in 2007. So he remembered that, and he gave me a call to give me a heads up that Wells Fargo was at it again. Trimont sets to become largest U.S. commercial loan servicer, buying Wells Fargo debt portfolio. Now, this reminds me of Countrywide Mortgage. Many of you are not going to be old enough or have enough experience enough to remember Countrywide Mortgage. Countrywide Mortgage was the largest. This was not a money center bank. They were a mortgage provider. They were bigger than the largest banks in the United States in that sector. They loaned to anybody. Countrywide Mortgage ultimately was run by Angelo Mazzillo. Ultimately, they went belly up. Government made Bank of America buy Countrywide Mortgage and Merrill Lynch. So this is reminiscent of that type of divestiture of a large money center bank getting rid of their subprime business because they see something coming down the pike. So could this be the major concern out there? In reality, is not necessarily jobs by the Federal Reserve, but the commercial real estate market. Adams, I saw this when I was going through this. Adams reportedly directs agencies to cut 550 property office footprint. So they continue to divest real estate in Manhattan, and right now we have roughly the equivalent of 3 or 4 Empire State Buildings vacant in Manhattan, and it's only going to get worse. So that's the news that's fit to print going into the new trading week. Don't forget to enter your email address, link above Twitter, link below YouTube, or use that QR code, and I'll see you on the other side. Let's talk about stock chart requests, and we have a couple to go over. SoFi. Let's go to the weekly chart. A lot of people interested in this stock. Weekly chart. We remain in a downtrend channel, and we have yet to break out yet. So I can't buy into weekly resistance. Daily chart. A good day on Friday. But we need to keep in mind what we're using is TrendSpider. So I'm able to, and I'll put up their QR code now. I'm able to, that's their, you want 35% discount code, scan that code or use a link below on YouTube to get to their website. I get 35% off. They give a 7-day free trial offer. I like it so much, I give it away free to our silver and gold level members. Back to SoFi, back to our regularly scheduled programming. Nice breakout on Friday, but we need to keep in mind that we have weekly resistance right here, right where we hit the highs on Friday. That's where you have weekly resistance. So I can't buy it here despite the good price action on Friday. And it still remains in a downtrend. ORGN. Wow. For this, I need to go to a monthly chart to get a vibe. Nice stair-step breakout. Weekly chart. I need to bring up Bollinger Bands here. This looks awful extended to me. Yeah, we're above the Bollinger Bands. I think these are only the 2 standard. Oh no, these are the 3 standard deviation Bollinger Bands. Avoid, avoid, avoid. Also, take note that you have a volume shelf right here at 153. If it closes down below 153, it's going to be in trouble if it closes out the week down there. But if we do a retest, bounce around, and consolidate above 153 per share, and we break out, then it's game on to the upside for ORGN. Right now, I would wait and see whether or not we hold 153. I think it does. It closed above a formidable volume shelf. It may pull back down midweek. It doesn't matter if it trades down below 153. What matters is where it closes. As long as it closes back above 153, you can nibble on it with a tight stop right below it. And I would add more, again, on a breakout above this resistance level. And I would give it a couple of days of bouncing around here, actually a couple of weeks perhaps, before I got aggressively long of the share price. You want to make sure that this is a floor in the share price. Daily view. We broke out on Friday after a pullback, and there's that 153 mark again. So that's your line in the sand. Let's take a look at the fundies here. Looks like they had a good quarter, and that drove up. This is revenues. So the revenues rose fractionally. I mean, not great. So I'm not sure what the story is here, but this quarter here, the Q1 quarter was wild. That's coming off of low expectations probably. CLW. Clearwater Properties, you have to avoid this. It's had a great rally, hit resistance, weekly resistance. I'm sorry, daily resistance. Let me go to the weekly chart first. Wow. The weekly chart looks like as though they could have more left in the tank here, but you do have overhead supply here. And that's exactly where we got stopped. 34.36 is your line in the sand for the stock. If it closes the week out above that mark, maybe you move up higher. Right now, you have a lot of sellers from back here, 22, 23. They want their money back. All right, they lived through this nightmare of a sell-off. Daily view. And here you have resistance immediately above. This to me looks like a dead cat bounce. I would avoid this stock. EMR, Paul? You got it. You're welcome, Tim. SoFi started to scare me, which I sold much higher before earnings with a small profit. Good for you. Congrats on that profit. All right, we'll leave it off with EMR. Emerson Electric. Wow, this is an oldie. Real oldie. Revenue growth is declining here. The price action on the month is simply horrendous. We bounced off a monthly support. It's had a heck of a rally. We've gone from putting in higher highs and higher lows to now breaking down. Here was a line in the sand right there. So higher high, higher high, higher low, breakdown. The rally's over. The bull market in Emerson appears to be over right now. I would avoid this, and it's quite possibly a short. So I would avoid this stock. You're welcome, Sean. Yep, catch you in the morning. Folks, thanks for being here. Everybody have an awesome night. Have a profitable trading week. Don't forget about the public forum that we're opening up. It's going to be really, really cool. That'll be our next. It won't be Sunday Night Futures Live. It's going to be Monday Night Futures Live. Labor Day weekend. That's the launch. I'll see you there inside the members area or the public forum area. No credit card required. Join us. Thanks for being here. Have an awesome weekend. Enjoy the remainder of your Sunday. Be well.